Most valuation measures for the US equity market, certainly the absolute valuation measures, have been telling us for some time that the US equity market's expensive. One valuation model, however, that has, I guess, kept investors in the US equity market has been the equity risk premium. And that's the chart showing here in front of us, tracking back to the mid-1980s. So the equity risk premium, obviously a function of the low bond yields, but also it's based obviously on earnings projections, both short-term, medium and long-term earnings projections. And that has come in, but it's still sitting well above the long-term average. And this is one of the factors that has kept investors in US equities. So the equity risk premium on our measure, and this is using IBIS consensus earnings data, has the risk premium down to about 4.8. So it has been declining, partly because of rallying market, but also because of the rise in US bond yields. Now, as I said, the long-term average is around about 4%. So it would appear that it's still value relative to the current bond yields and given current EPS growth assumptions. However, let's just test this model out a little bit, and we'll look at its sensitivity to different bond assumptions. And given that we've seen the recent rise in bond yields, I think this is probably an appropriate thing to do. As we saw over the last couple of days, the lift in bond yields above, say, the 3.1% level was a significant break up and sort of puts the US bond market back into levels that we really haven't seen since 2011. So it's a good time to revisit this equity risk premium model. Before we investigate some of those scenarios for bond yields, let's just look at a couple of the inputs into the equity risk premium calculation. Now, 12-month forward EPS growth, as we know in the US, that's the pink line here. Obviously, that picked up with the tax cuts, sort of up to around about 17 or 18%, and it's just eased back, but it's at quite elevated levels, around 13, 14% at the moment. That's one of the inputs to the model, but also the model uses an estimate for 3 to 5 year EPS growth, and that's represented by the blue line. And now typically that's very stable at around about 11 or 12%, as you see here, going back to 2006-7. But for some reason it's pushed up quite sharply, and it's now sitting above 16%. So obviously this is a very significant lift, and so what we're interested in is if we assume a more normal longer-term EPS growth rate, what does it do to the equity risk premium model and valuations of for the US equity market? So we're just going to go back to the previous chart. So that's the current equity risk premium model. Now, if we use the long-term average for medium-term EPS, let's just do that now. Now that's the dark blue line. You can see the difference it makes. It makes about a 0.3% difference. So, you know, reasonable, but not overly significant. But it certainly does make a difference. So it reduces the equity risk premium, so to about 4.3 from, or sorry, about 4.5 from 4.8. So it makes it look slightly less attractive, although, you know, it's still well above the average. Now, we talked earlier on about using different bond regimes, and in this particular chart that I'm adding now in the dark blue line is, well, what if we kept everything else the same, but we made US bond yields 3.5%, so some sort of normal level, and that's our expectation, that bonds go to 3.5. But if we assume that that had been the case from around about the time of the Great Recession, this is what it does. And so basically it suggests that the equity risk premium based on a normal bond yield, if you like, of 3.5 has the equity market, you know, around about average on an equity risk premium model, maybe slightly attractive. If, however, we relax both assumptions and say that bond yields at 3.5 and that lower medium-term EPS number that we were suggesting, that's now the red line. You can see here that now brings the market back to in line with its long-term average rate of about 4%. So basically that would suggest that under those sort of more normal assumptions for bonds and medium-term EPS, the equity market is about right relative to bonds at 3.5%. So basically what it's done is sort of removed some of the attractiveness that of US equities relative to bonds. However, we also have a model of the equity risk premium, and I'll just bring that up here now. That's now the light blue line, and that model actually uses the output gap. It uses a measure of the ISM. It also uses the Fed funds rate and measures of uncertainty and spreads in that particular model. And based on a very strong ISM reading, the current Fed funds rate around about 2.25, an output gap that's basically largely been removed, or in fact starting to push above into sort of late cycle, suggests that the equity risk premium should be somewhere around about 3.7. So on that basis, it says there's still value in the market, either in the market or bond yields have to rise a bit further. So to summarize, the equity risk premium in the US may look quite attractive still on face value. However, once we start to incorporate a more normal bond yield, let's say 3.5%, and once we start to incorporate, I guess, more typical long-term EPS growth assumptions, then the relative value in equities is greatly diminished. Doesn't say that the equity market is outright expensive. It just says it's no longer as attractive now to bonds. Thank you.